Why some Americans are approved for $50,000 loans in minutes while others are denied for $500. An analysis of the hidden algorithm. At 2:14 on a Tuesday afternoon, two people hit submit on a loan application within about 90 seconds of each other. Neither one knows about the other. They're not connected in any way. But watch what happens next. Applicant 1 is applying for $50,000 to renovate a kitchen. 60 seconds after hitting submit, approve. No human ever looked at the application. A green check mark, a funding timeline, done. Applicant 2 is applying for a $500 personal loan to cover a car repair. 40 seconds after hitting submit, denied. No specific reason given beyond a form letter mentioning creditworthiness. Same afternoon, same type of decision. Wildly different outcomes and wildly different amounts in the opposite direction of what you'd expect. The smaller ask got denied. The bigger ask got approved in under a minute. What actually happened in those 60 seconds is not mysterious. It's not random. It's not really even about the two people being fundamentally different kinds of borrowers in the way most people assume. It's a specific, automated, multi-factor system that most Americans have never seen explained clearly because most of the people building these systems have no incentive to explain them to you. Today, we're opening the black box. My name is Nick. Let's get into it. Let's start with what most people think is happening because the common mental model here is almost cartoonishly oversimplified. Most people believe loan approval works like this. You have a credit score. If the number is high, you get approved. If the number is low, you get denied. Good credit? Yes. Bad credit? No. One dial, one outcome. This is not how it works, and the gap between that belief and reality is exactly why applicant 2 got denied for $500 while applicant 1 got approved for 100 times that amount. What's actually happening when you hit submit is that your application gets run through something called an automated underwriting system. This is software, not a person, built by the lender or a third-party risk company designed to pull data from multiple sources simultaneously and produce a risk score in seconds. Here's what typically happens in roughly the order it happens, all within that 60-second window. First, the system verifies your identity and pulls your credit report from one or more of the 3 credit bureaus. This takes a couple of seconds through automated data connections that didn't exist 20 years ago. Second, it calculates or retrieves your credit score, but this is just one input, not the final answer, despite what most people assume. Third, and this is the part almost nobody talks about, it calculates your debt-to-income ratio using income data you provided plus debt obligations pulled from your credit report. Fourth, depending on the loan type and lender, it may pull additional data, bank account information through services that can verify your account balances and cash flow patterns in real time, employment verification through payroll data services, and sometimes alternative data like how long you've had your current bank account or your utility payment history. Fifth, all of this gets fed into a risk model, often built using machine learning trained on millions of past loans that outputs a probability of default. If that probability is below the lender's threshold for the loan amount and terms requested, you're approved. If it's above, you're denied. All of this in under a minute. No human read a single word of your application in most cases. Now let's talk about the credit score itself, because even though it's just one input among several, it's the input most people understand least, despite thinking they understand it completely. There are 2 major credit scoring models in use in America. FICO, which is used in the vast majority of lending decisions, particularly mortgages, and VantageScore, which is increasingly used by some credit card issuers and alternative lenders. They use similar but not identical formulas, which is why you can have a 720 on one and a 690 on the other, and why checking your credit score through different apps sometimes gives you genuinely different numbers. Here's the actual FICO breakdown, because almost nobody has seen the real weighting. Payment history is 35% of your score. This is the single biggest factor, and it's exactly what it sounds like. Have you paid your bills on time? One 30-day late payment can drop a good score by 60 to 100 points, and it stays on your report for 7 years though. The impact fades over time. Amounts owed is 30%. This isn't just your total debt. It's heavily weighted towards something called credit utilization. utilization, the percentage of your available credit you're actually using. Someone with a $10,000 credit limit and a $9,000 balance has 90% utilization, which is treated as a significant risk signal, regardless of how reliably they pay. Someone with the same $10,000 limit and a $1,000 balance has 10% utilization, which looks excellent, even if their total debt across all accounts is identical, in dollar terms, to a completely different person's situation. Length of credit history is 15%. Older accounts help. This is why closing your oldest credit card, even one you don't use, can quietly hurt your score by shortening your average account age. New credit is 10%. Every hard inquiry, every time you apply for new credit, dings your score slightly and signals potential risk if there are several in a short window. Credit mix is 10%. Having a combination of credit types, credit cards, an auto loan, maybe a mortgage, shows you can manage different kinds of credit responsibly, which is why someone with only ever having had one credit card sometimes scores lower than expected. Notice something about this breakdown. 65% of your score comes from just two factors: paying on time and keeping your utilization low. Almost everything else is secondary. Most credit building advice online buries this under a pile of minor tips when the actual signal is remarkably concentrated. Here's where it gets interesting, and here's the part that actually explains our two applicants from the opening. Two people can have similar credit scores and receive completely different loan decisions because the score is not the only thing being evaluated, and for many loan types, it's not even the most important thing. Debt-to-income ratio, often abbreviated DTI, is calculated by adding up all your monthly debt payments and dividing by your gross monthly income. If you make $5,000 a month before taxes and your monthly debt payments, rent or mortgage, car payment, minimum credit card payments, student loans, everything, total $2,000, your DTI is 40%. For many loan products, especially larger ones like mortgages and big personal loans, lenders have hard DTI ceilings. Many mortgage lenders won't approve a loan that pushes your DTI above 43 to 50%, depending on the loan program. Personal loan lenders often cap around 40 to 45%. Above that ceiling, it often doesn't matter how good your credit score is. The math itself disqualifies you because the lender's model has determined that regardless of your payment history, you don't have enough monthly income headroom to reliably absorb a new payment. This is the piece almost nobody calculates for themselves, and it's often more decisive than the credit score for anything beyond a small credit card. Now here's the twist that explains our two applicants directly. Applicant 1, approved for $50,000, had a strong credit score, yes, but also had a DTI of 22%, plenty of income headroom relative to existing debt. The system saw low risk from multiple angles at once. Applicant 2, denied for $500, actually had a decent credit score in the high 600s, not bad at all by most standards, but their DTI was already at 51% before the new loan, largely from a car loan and existing credit card balances. Adding even a small new payment pushed the model's projected risk over the lender's threshold. The credit score said reasonably reliable borrower. The DTI said no meaningful room for a new payment, regardless of reliability. The DTI won. This is the hidden algorithm the title promised. It's not really hidden in the sense of being secret. It's hidden in the sense that almost nobody explains it to consumers in plain language, so it feels mysterious, even though it's a fairly mechanical formula once you see it laid out. Let's talk about speed, because the difference between a 60-second decision and a 3-day decision is also not random. Instant decisions happen when a lender's automated system has high confidence in its data and the loan falls within clearly defined risk parameters. The applicant's numbers clearly clear every threshold or clearly fail every threshold, with no ambiguity requiring human judgment. Slower decisions happen in the ambiguous middle, when your DTI is borderline, when your credit history is thin, when there's a mismatch between stated income and what verification services can confirm, or when the loan amount is large enough that the lender's policy requires human underwriter review regardless of what the algorithm says. Mortgages almost always involve human review specifically, because the dollar amounts and risk are large enough that full automation isn't considered acceptable, even though an algorithm does most of the initial work. So paradoxically, a very fast decision usually means your numbers were unambiguous in one direction or the other. A slow decision often means you're sitting in a gray zone the algorithm can't confidently resolve on its own. Now, here's something almost nobody realizes they're legally owed. If you're denied credit in the United States, federal law, the Equal Credit Opportunity Act and the Fair Credit Reporting Act requires the lender to send you an adverse action notice. This notice has to include the specific principal reasons for the denial, not just a vague reference to creditworthiness. It also has to tell you which credit bureau's report was used, and you're entitled to a free copy of that report within 60 days. Most people who get denied never read this notice carefully, or don't realize they can request more detail, or don't realize the specific reason codes actually tell you exactly what to fix. Reason codes like proportion of balances to credit limits is too high, or insufficient income relative to obligations are not vague. They are precise diagnostics telling you exactly which lever to pull. Applicant 2, after being denied, actually reads the notice carefully for the first time. The specific reason listed is high DTI relative to requested amount, not a mysterious bad credit, a specific, fixable, quantifiable ratio. So what do you actually do with this? Here are the levers that genuinely move approval odds, not vague advice. To improve your credit score specifically, focus almost entirely on the two factors that make up 65% of it. Pay every bill on time, every time, because even one late payment is disproportionately damaging. And keep your credit utilization below 30%, ideally under 10% if you're optimizing hard, by either paying down balances or requesting credit limit increases on accounts you already manage responsibly. To improve your DTI specifically, you have exactly two levers, and they're symmetrical. Increase your income or decrease your monthly debt obligations. Paying off a car loan or a credit card entirely removes that monthly payment from the calculation completely, which often moves DTI more dramatically than paying a large balance down partially. If you're planning a major loan application in the next 6 months, this is where to focus disproportionate energy, because DTI often matters more than most people think and gets almost no attention compared to credit score. And if you are denied for anything, actually read the adverse action notice. Request the specific reason codes if they aren't fully detailed. That notice is not a formality. It's a diagnostic report you're legally entitled to, and it tells you precisely what the algorithm flagged. Applicant 2 spends the next several months doing exactly this. Pays off the car loan entirely rather than making extra payments toward the credit card, because the math shows eliminating that specific monthly obligation moves the DTI the most. 6 months later, DTI has dropped from 51% to 34%. Same credit score, roughly. Same income. One specific number changed because one specific lever got pulled. The next loan application, a similar $500 request, gets approved in 11 seconds. Nothing about them as a person changed. Nothing about their character or reliability changed. One ratio moved below one threshold, and an algorithm that had said no 6 months earlier now said yes instantly. The system isn't secret. It's just unexplained. Automated underwriting runs on a specific calculable formula involving your credit score, your debt-to-income ratio, and a handful of other verifiable data, points, weighted, and combined into a risk probability that either clears a threshold or doesn't. Once you know what's actually in the formula, it stops being a black box that mysteriously likes some people and not others, and starts being something you can actually see, calculate for yourself, and deliberately move. Go calculate your own DTI right now. Add up your monthly debt payments, divide by your gross monthly income. That single number might be doing more to determine your financial life than the credit score you've been checking every month. I'll see you in the next one.